The FOMC is likely to lower the target range for the Fed funds rate by 25 basis points to 4.25%, 4.5% on Wednesday. We expect the main message of the December meeting to be that the Fed anticipates that it will likely slow the pace of rate cuts going forward. And Goldman has revised our forecast for 25 to eliminate a cut in January.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci. Today's market rundown will be prepping for the Fed meeting today, tentatively titled Hawkish Cut, and we'll get into that. We also have a couple other things to discuss. Let's start with the markets. 10-year yields are up 2 at 441. The dollar is 106.99, remaining strong, up 6. S&P 500 is 60.67, up 22. The VIX is 15.27, down 61. Gold is 26.43, down 250, $2.50. Silver is 30.36, hanging in there, down 16. Copper is 411, up a smidge, right? WTI is 70.71, up 56. Natural gas is 318, down a penny and a half. Bitcoin 104,763. That thing went up to like 107, almost 108. I think it might have breached 108 yesterday, but now it's down below unchanged. So now it's 104,780, down to 1,300. Ethereum is 38.55. I think going as high as 4,100 yesterday. Maybe a short-term blow off top. Let's see. Palladium 925 at 10 and change, down 10 and change. Platinum 932, down 7 and change. Gold, silver continues to strengthen. Grains are mixed. Soy is down 13. Let's pull that up. Soy is 960, down 13. Corn is 432, unchanged bid. And wheat is up a penny and a half at 549. Okay, there's the front page. India wants the gold. That's yesterday's conversation that we had. And what we just read this morning is going to add to that. We'll share a little bit of it with you. We're in the process of processing it ourselves. Top left-hand side, Goldman Central Bank's China double down on OTC gold buying. That's an analysis that we did of a piece by a Goldman analyst showing that physical demand is bigger than they had expected. Very pointed article that we thought was bullish, but we kind of downplayed it. We said, okay, it's bullish. They're putting upside risk on their prediction now, which is kind of interesting for them to do. And the reason for that is in the lower left-hand corner, there was a report that had come out about a week earlier that we just got a look at, and Goldman pushes back on the gold bears. We'll be doing a write-up on that either tomorrow or for the weekend. I'm not sure. But that's the founder's preview. Zero Hedge did a nice write-up on it. Basically, when Goldman said $3,000 by the end of 25, which is not a crazy call, they got a lot of pushback, and a lot of the pushback was from banks that were saying the dollar is going to be strong and that's going to hurt gold. Keeping it simple, and from their peer group, right? And well, this analyst. She pushed back in this report that we're alluding to here. And her reasons, without patting ourselves on the back too much, are our reasons that the demand for gold coming out of central banks, specifically easiest to identify, BRIC central banks, is inelastic to dollar movement. And when you combine what we've observed with their physical demand statistics, which were showed in the report on the top left-hand side, with their thesis about how these central banks determine when and if to buy gold, dollar strength, dollar weakness, it just really comes together. And, I can't believe I'm saying this because Goldman picked my pocket for 20 years trading metals, but they're right. Anyway, we're going to write that up. It's impressive. We rarely see this sort of open debate between ideologically driven banks. Goldman's about making money. The other banks are a little bit more ideologically driven. Okay. Anyway, moving on to the story. Today's discussion is hawkish cut. There's Goldman's take. I'll read that to you, but just to give you a little preview. The recent decline in inflation rate has kind of stalled, but November's CPI and PCE comes in this week, is extrapolated as still being good enough for the Fed to deliver another rate cut today. Interest rates remain tight, relatively speaking, and the Fed wants to avoid further weakening of the jobs market, the labor market. The fact that the Fed is likely to cut interest rates by 25 basis points is largely priced in by the market stirs. Now, the stock market just keeps rallying, which ignore that for the analysis. It's rallying maybe for different reasons. Uh, the outlook for 2025 is where the banks are now changing gears, right? They're all starting to say, oh, we might have been over optimistic on rate cuts, right? So since the last meeting, growth has surprised to the upside. We've seen that, right? And a slower decline in inflation suggests that the Fed members will continue to emphasize data dependency, increase their interest rate forecast for next year, and also signal a higher final level for interest rates. Now, let's just read Goldman's take, okay? The FOMC is likely to lower the target range for the Fed funds rate by 25 basis points to 4.25%, 4.5% on Wednesday. We expect the main message of the December meeting to be that the Fed anticipates that it will likely slow the pace of rate cuts going forward. And Goldman has revised our forecast for 25 to eliminate a cut in January. We continue to expect cuts in March, June, and September this year, and now expect a slightly higher terminal rate of 3.5 to 3.75, 3.5 to 3.75. So that's Goldman's take. Now, they also add that the key question for the statement, so he's going to say 25 basis points, 95% sure, right? The key is going to be about the statement that they write and the press conference. So the key question for the statement and press conference is the relative emphasis put on slowing the pace versus on decisions remaining meeting by meeting and data dependent. So what do I mean by that? Are they going to come out and say, we're slowing the pace, right? Which is kind of definitive. Are they going to come out and say, we're going to skip January, maybe we'll go to March for the next cut? I don't think there's a meeting in February. Or are they going to say, we're still on pace, but we're data dependent? So one is we're letting you know that we're slowing down. The slowdown is coming, right? You're holding hands that way. A little bit of tough love holding hands. And the other one is we're still on the same path, but we'll let you know depending on the data. So have they seen enough data to come right out and say, we're going to skip it. We're going to skip a rate cut. And that's, I think, what banks are focused on. And, it's actually kind of important. It's a distinction with a difference, but that's the point. Goldman also expects to hear both messages that I just described, including an addition to the statement that nods towards a slower pace. So it's going to be phrasing. It's going to be, while we think this, we could see that. One of those type of things. I'm not sure, but these words matter a lot. Because the bond market, the short-term interest rate market, is discounting that the Fed's going to slow down. Okay, so now the question is, assuming that the market is right, okay, in their assessment, how are they going to slow down? Are they going to slow down and let you know, or are they going to slow down and say we're not slowing down, but we could slow down? So that's it. But it matters a lot, and it matters a lot for the interest rate environment. The question is, does it matter for stocks and gold? Well, it might not matter for stocks because they're in their buy season, and their buy season is a little bit later than precious metals because there's tax selling followed by buying going into the new year. Gold's buy season, we're well into it now. And historically, gold has a 2 to 4 week area here where it averages much higher than the other months. But we would remind you that, as we did yesterday, that while the average is higher, the volatility is also higher. So that's Goldman's take and our take on their take. Here's a chart. That's an inflation chart, courtesy Rabo. And, it doesn't really look impressive, like it's hurting in any way. But the headline CPI inflation is the one that's upticking. And with headline CPI inflation upticking and the PPI that came in very hot, it's almost like you got hot inflation here and hot inflation coming down the line, and it's working its way through, and inflation may have bottomed. Rabo's take, we expect a hawkish cut in December, similar but not the same. This means a 25 basis point cut, accompanied by indications that the Fed is going to slow the pace of rate cuts in 25, both in the dot plot and the press conference. Dot plot is their expectations, right? We still expect only one rate cut of 25 basis points to 25. However, because of the recent data, we now expect the Fed to wait until March instead of continuing in January. So here we go. December, banks are starting to say skip January, head into March. So if the Fed doesn't say skip January, or the Fed gives the impression that they're not going to skip January, everything could rocket. If they say it, then it's kind of like, let's see what happens. And if they say they're skipping until, June, I'm making that number up, that date up, right? Then the market could really crap out. So they're going to seek to soothe the market, whatever they think the market wants. We continue to expect a rebound in inflation once Trump raises tariffs on a wide scale. For this is Rabo still. For the Fed, this means that they will have to pause the cutting cycle during the course of 2025. Okay, so if Trump does what he says he's going to do, you're going to have an increase in tariffs, right? Which is inflationary domestically. Okay, prices of things go up. That's the conventional wisdom, and it's also going to be put in place with tax cuts, so that increases the deficit. And so people think Powell will push back on that or balance that by cutting less. And that's also the consensus, which it doesn't seem to be wrong, at least to our eyes and ears. Moving on, news and analysis. Yesterday, we put out 3 stories. India wants the gold. You know that one, unwinding the Yellen pivot. That came out late in the day. And, well, do you remember when everyone was saying Powell's going to pivot, Powell's going to pivot, Powell's going to capitulate, and he didn't? Well, that's because he didn't have to, because Yellen pivoted. Remember when Yellen, you may not remember, but Yellen, because Powell wouldn't pivot, wouldn't lower rates, she decided to take all the, I'm exaggerating, but it's similar, right? All the money that we were going to borrow in the 10, 20, and 30-year area and just say, screw it, I'm going to borrow in the short term. And in doing that, she took pressure off the long bond, which allowed him to ease sooner. But that pivot, so to speak, kind of like her own internal yield curve control, is one of the main reasons that stocks rocket. And there's a really nice chart discussing that. The unwinding of the Yellen pivot means, essentially, are we going to stop borrowing in the short end and start borrowing at the long end? Well, that would be bearish for stocks, okay? And it would be bearish for bonds. And it would also be kind of like draining the pool of water. The liquidity would come out of the market pretty fast. And how would the market take that? That's the question. Did Yellen just feed our addiction? And now we have to come off of an even worse addiction? Probably. All right. Morgan Stanley asked the big questions for 2025. That's a founder's post we put out. And very big picture, and it's a good piece. Moving on, market news, cars, banks, and AI energy. We were going to go through all this today, but we wanted to do the Fed thing. But in auto world, you're seeing a vertical consolidation, a vertical integration, a roll up of the industries as they fight to compete with Tesla, right? As they fight to compete with EV development. So you have Honda, Nissan, and I think Mitsubishi's, they're working on Mitsubishi combining. So I guess that leaves Toyota and those 3 in Japan. So that's not a good sign for Ford and GM. Okay, why? Well, because if they're bigger and they're connected and they're stronger, then they're going to be able to compete in the more competitive environment. Ford and GM, not so much. GM isn't a car company anyway. GM's a finance company still. Anyway, Bank of America Chief Executive Officer Brian Moynihan said regulators need to reassess and relax rules they set for banks in what could be the biggest change for the industry under a Trump administration. So Trump is a deregulator, And the banks are going to lobby for deregulation. And it's not just like they want it easy. I mean, they do want it easy. But, because the world is selling treasuries, right? We need someone to buy them. And the Fed has the banks in its sights to buy those treasuries. You can raise reserve requirements, which forces them to hold more treasuries. And those things would really make it hard for them to trade and make money. They'd have to have more bonds and less money to speculate with. You have to have more money in reserve. And so the banks have been pushing back on this for some time. And one of the ways they push back is by not buying bonds. And you're seeing below the surface, there's a battle going on between regulatory agencies, including the Fed and the Treasury Department, and the banks. So the banks provide the liquidity. They're like, hey, without us, the money's not going to go from point A to point B, right? The government provides the rules. So there's a battle going on under the surface here. It looks like the banks are going to get their way with Trump coming in. Next, hedge funds are getting more and more interested in energy. This is not news to us. If you're buying AI companies because people are going to buy these cool chips, then you need to buy data centers or build data centers. So you buy picks and shovels of things that build data centers. And then you have to look at your traditional utilities and say, well, how is this going to be powered? You go back to the merchant energy era of the late 90s and early O's, the Enrons, the El Pasos, the Constellations, the Duke Energies, the Duke Powers. Those are going to become in focus today because of that. So here's a chart that we created. This is our Trump chart, right? So what do you buy under the Trump administration, or at least what's being bought right now? Picks and shovels. Now in the lower part in small green, it says nuclear. And I should change that to utilities, right? So what do you buy under Trump? Well, Trump's a real estate guy, right? He wants physical things, right? And AI in the lower left-hand side is coming in, so you need power and infrastructure. And on the right-hand side, you have a country that needs to return to manufacturing. So at the top, you have Trump, who's a corporatist. In the lower left, you have a need to rebuild our distribution networks. And in the lower right, that's mercantilism. And where does it intersect? Picks and shovels. You have to buy things that build things. You could also buy utilities that are in charge of the money. That's where we put nuclear in there. So I guess we should make that the utilities, but that's the whole concept. Fed Day. Fed Day's today. We know that. There's the Rabo comment in more in full. And let's take a look at the markets. Silver, okay, so it's below the 100-day moving average, but the 100-day moving average is sloping up. As long as that continues to slope up, I do not think you'll see people get too short. It's probably a buy in this area. Surprises from the Fed notwithstanding, but we are at a position here. There's gold. There's gold. Sideways. I'm trying to look for a bullish perception on this. And I know I've been very neutral the last couple of days, but there is one bullish take that is worth sharing. I'm not saying this is an algorithm, but this ratcheting up and then collapse, and then buying and ratcheting up and collapse, this could be a slightly impatient buyer. So let's assume that some of this impatient buying has been buying of dips by people who are looking forward to gold being strong despite a strong dollar. I guess what I'm saying here is this is buying of the patient kind that is catching falling knives from the funds as they sell. CTAs are a little strong, a little long, and probably going to get a little bit impatient because they're also long the dollar. So as the dollar gets stronger, CTAs will sell. And if the market comes off, you want to see who catches it. The key to this range, to me being right about this range, is the RSI. Look at it, right? It's flatlining. I wouldn't pick a direction until the RSI picks a direction. All right, I'm Vince. Everyone have a great day, and I'll see you tomorrow.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions. And thanks for watching.